Morning, everybody. I thought this was the quickest way and the easiest way to have a quick chat with you all about current market events, the budget later today, and just a little summary of how things are panning out. So we've seen quite a fall in the stock market over the last couple of days, and you will have seen gloom and doom on the news. Some of you may even have had a 10% letter. Fund managers now have to send a letter out to invested clients if their holding in that fund drops 10%. So I know a couple of those have come out, but I think only a couple. But I just thought it was quite a good opportunity to just reassure you. We've planned for it. We've built it in. I've tried to make things tolerant of this kind of thing. Each of your cash flow models, the bar chart, the multicolored bar chart, has a market correction, the same as the banking crisis, built into it every 10 years. It's built in the first year because I've been expecting a bear market for the last 2 or 3 years, and I think you've probably heard me talk about that a little bit. But what I wanted to show you was that actually a bear market's not a bad thing. It's probably a really good buying opportunity, but it's also don't panic, don't worry about it. So this is a graph of the performance of the stock market since 1926. The dark blue bits are the bull markets that we've had. There are some quite significant ones. So this last little blip here, I think you can probably see a little bit closer maybe. This is the banking crisis. This lasted for a very short time in recession. Its actual recession was 1.3 years. The previous one to that is the technology bubble in 2000. Again, a relatively short-lived but fairly dramatic fall. The point is though, and I don't know if you can see this, I'll put this quite a lot closer, the way it recovers generally is incredibly dramatic. You see this gradual fall, we all get used to it. And then you see what is called capitulation, which is when we all throw our hands up in horror and say, oh my God, thanks very much, I'm out, I'm bailing, I'm selling. And it's at that point that you see valuations fall so low that fund managers wait and pounce. And they buy at that point, and you see this instant, almost days, weeks recovery from a massive fall to probably half of the gain, a gain of half the value of the fall. It's incredibly difficult on that basis to time the market. End of the tax year, if you're thinking about making pension contributions or doing your ISA or investing anything like that, now is a cracking time to do it. If we went into any other shop, if you're going to go and buy a car and you went in and the market was, the salesman said to you, oh, by the way, it's 20% down, you would just leap at it and say, yes, please, I'll buy more. It's very counterintuitive investing that. We want to walk away from it because it's too scary. So then the only other thing I wanted to show you all is the way that we build portfolios and the things that we've built underpinning your cash flow, your life, your wherever, are not based purely on the FTSE. So you won't be subject to these 20% falls. So this is if you're a balanced investor. You can see the stock market's the purpley blue line, the B, that's fallen away dramatically. And the top line is the impact of a balanced portfolio. So you don't have just stocks and shares, you have some property and you have some equity. So this is if you're slightly higher risk with me. There are a few you tend to be younger people out there like this, but you can see the portfolio holds up quite well when there's a fall. The falls are offset by the holdings of stocks and gold and things that are in there as well. If you're more at the cautious end or approaching retirement, you're going to be in this portfolio, which is the cautious, which is the blue line at the top. Again, it just holds up much better. When we saw the Brexit announcements earlier, God, however long ago now, 2-3 years ago, some people approaching retirement or needing the money for a reason, or actually just worrying a bit more about it, we moved your portfolios back a step, and that will be to that cautious portfolio. So you've still seen the growth, and overall growth year on year is probably still 5 or 6% for that, and probably more like 3 or 4 for the balanced because of the risk profile of it. It'll recover and bounce away better, but it's just the way it is. So this is a really cheap way of me contacting an awful lot of you at once, but I just wanted to put something out. We've seen a rate cut this morning. Great stimulus to economy, hopefully stop us going into too deep a recession. We don't often see an oil conflict and an epidemic at the same time. So it's quite interesting times. I think it is. And if you're brave enough or young enough, it's a fabulous time to put money into the stock market before the end of the tax year as well. As always, give me a call if you see anything or think anything, or you've read anything in the press or anything bothers you, please phone me and we can talk through your particular situation and actually what your money's doing and your portfolios. Finally, anyone invested in Prudential, similar to the cautious portfolio, but there's a smoothing mechanism underneath it that just takes out the volatility. They've declared a price increase just recently, which is rather nice. And the growth rate's still the same, 4.6 on their PruFund Growth and probably 4.2 on the cautious, but there's a 0.9% price uplift on it a couple of weeks ago. So yeah, all doing the right things and all managed hopefully the right way, and we shall just see what happens, but you're in the right boat to ride it out. But again, give me a call if you need to. Don't think it's a silly question. I'd far rather talk to you about it. The office number is 01488 682 890, just to save you looking it up, or email me, jessamy@browndogfp.co.uk, and I'll talk to you soon. All right, take care, bye.